This is Wayne Rivers at Performance Construction Advisors, where we build better contractors. Did you know that 10% of our members are ESOP companies? We didn't know that. We just found out last year when we did some homework. And there's a ton of interest in ESOPs. We have lots of inquiries, and we're not experts, but we know people who are. ESOPs are not for everyone. They're not a panacea. They don't estimate, and they don't execute projects, and they don't keep score. But they're important. They could be a tool that would be helpful to you in terms of ownership succession. So we're going to give you some education about ESOPs. Two things. If you have questions, type them into the bottom right in the chat area, and I'll monitor the questions for you. And please take a look now and mute yourself. We do not want to hear your dog barking or a car crashing through your back room. We want to have a quiet and orderly group here. And I would like to turn it over to Bob Massengill and Mary Beth Gray, probably the two top ESOP brains in the entire country, if not the entire world. So Bob and Mary Beth, please take it from here.
Thank you so much, Wayne. Bob, I'll go first, and then before we get started, I'll turn it to you to say hi. Good morning, everybody. Thanks very much for joining us. My name is Mary Beth Gray. I'm a lawyer in Philadelphia, and I spend a lot of time doing ESOP work, both in the creation side to create the ESOP to purchase stock, and then also in the ongoing maintenance side. And as Wayne mentioned, there's a ton of interest right now among construction companies in doing ESOPs, which we're delighted to see, and we're going to talk a little bit today about the mysteries of that and the beautiful benefits of it, and we'll try to keep things moving along because we have a lot of things to talk about.
Good morning. I'm Bob Massengill, co-founder of Pilot Hill Advisors and Pilot Hill Capital. We are company-side advisors that help owners evaluate and implement ESOP transactions. We do valuation work, we raise financing, and we otherwise quarterback transactions to help our contractor clients get through these transactions. Of all the industries that we serve, we probably do more business for contractors and subs than just about any other industry. So we're pretty familiar and are quite active in this arena. So with that, Mary Beth, why don't you kick it off?
Great, thank you. So as Wayne said, you can put questions into the chat and we'll try to address those as we go, but our contact information is also at the end of the presentation. Please don't hesitate to reach out to us. There's a lot that we're going to talk about today. A lot of it is a little, complex. You're going to have to hear it more than once. But we're not going anywhere, and we're happy to answer your more detailed questions if you have them. So to kick things off, I hope everybody can see these slides moving ahead. We will, but if you have concerns, text them out, and we'll try to respond to those as we go. So the best comparison of what an ESOP is really is a 401k plan. The ESOP itself is a retirement plan. It's a defined contribution plan. That is its purpose. But in its life cycle, it has a couple of different roles. To start out, the ESOP is the buyer. So the seller puts the buyer across the table. The buyer is an ESOP trust, and the buyer negotiates with the seller to purchase the stock, just the way the buyer would in any other purchase transaction of stock. But then once that happens, those shares are sitting in an account for their benefit in a retirement plan. And so at that point, it becomes a company funded retirement plan. And from the company's perspective, it goes from having one owner or set of owners who are people to having an owner that's an ESOP trust. And so from the company's point of view, it's an effective succession planning and ownership transition tool. And maybe most importantly, it creates a tax exempt entity. So we're going to talk a lot about taxes in this presentation, but don't worry, we're going to try to make it as create as little tedium as possible in the tax conversations. But the good news is that if you have a company that's 100% owned by an ESOP, although this sounds too good to be true, it is a tax exempt entity. It does not pay federal income taxes. And for a lot of companies, that is a significant goal. It helps with cash flow, and it helps with a lot of strategic planning. So what does it mean? It is an employee stock ownership plan. It is, as I said, a qualified retirement plan under IRS rules, just like a 401k plan. Unlike a 401k plan or any other retirement plan, it is permitted to borrow money. That was its purpose when it was created. It makes it a unique strategic tool because it can borrow money from the company and use that money to purchase shares from a seller. The trust is the shareholder. So when we talk about a company being owned by the employees, the owned is a little bit in quotes because the direct ownership is in the trust. And the employees, although they have an important financial interest in those shares, they don't own those shares directly. So when we talk about shareholder disclosure, when we talk about shareholder voting, when we talk about shareholder participation, we're really talking about the trust. And if you have a company that has 2,000 employees, there's a single shareholder. If a company has 20 employees, it has a single shareholder. And those employees underneath that umbrella have an economic financial interest in what those shares are worth. We're going to talk a lot about valuation, and that's the benefit, the economic benefit that is driven into the retirement account. So the transaction is planned so that the ESOP trust purchases shares from the seller in an internal transition. That planning is really important. That's what Pilot Hill does. That's what Kleinbard does. But once that planning takes place, the seller is really driving the timing and a lot of the terms of the transaction. Generally speaking, companies should expect that all of the employees will participate in the ESOP. You can't pick and choose. There are some group exceptions to that rule, including collectively bargained employees. So union employees are typically excluded from an ESOP because they're getting their retirement benefits through a different source, through a collective bargaining agreement or defined benefit plan. But all of the employees who are hourly in the plan, in the company, who are not benefited by a union, the assumption should be, within certain limited exceptions, that all of those employees are going to participate in the plan. So when would you start thinking about using an ESOP as opposed to some other buyer transaction? When you have a seller, that would be the first question. If you have an owner or owners of a company and they're trying to figure out where that liquidity is going to come from, in my view and in Bob's view, an ESOP should always be on that list. An ESOP is an unusual buyer, in some ways a really advantaged buyer, but it's a buyer just like any other kind of buyer. And it can sit across the table from the seller and negotiate the purchase of those shares. But also what it provides is some unique advantages that other buyers typically cannot offer. One is that you have no change in management, leadership, or the board. As we're going to talk about, the governance of a company owned by an ESOP is the same as a company not owned by an ESOP in terms of who's on the board, who's the management team, who are the employees. For sellers, there is a significant tax advantage that we're going to talk about on the potential deferral of the capital gains on the sale. And then the unique advantage is that once the company is 100% owned by an ESOP, the company no longer pays corporate income taxes. And that also obviously is a significant advantage not offered by any other buyer. And then, there's a huge retention, motivation, and reward component of ESOPs that doesn't tend to exist in other ownership structures. A lot of companies are driving equity value into the hands of their employees through certain kinds of incentive plans or phantom stock plans or options. But this structure is designed to give an automatic company funded ongoing benefit to all employees in the form of company stock, while it provides the company the tax advantages to be able to buy back that stock from people when they retire or leave the company for other reasons, and they're entitled to get the benefit back. So we're going to cover again a lot of things about sort of how this works and when you start. We will, and we're going to get into some basic transaction structures. Bob's going to talk about that in just a minute. As we talked about, the shares are inside the trust. The employees don't own the shares directly. So the trustee represents those interests on behalf of the plan and makes sure that the stock value and the company's operations are such that there is a prudent, ongoing, viable benefit to employees provided by way of the stock. So that risk of profitability that right now sits in the hands of individuals in some ways passes to the trustee, and the trustee will make those decisions about how those benefits are going to be driven to employees and what the value is. That is the most important function that the trustee is performing every year, which is to determine the value of the business every year. So the trustee is determining value at the front end to decide how much the ESOP is going to buy the shares from the seller, and then the ESOP is determining the value year after year to figure out where, how that value is going to get driven to the people. In almost all instances, including possibly the most important thing, which is the vote on who's on the board of directors, the ESOP trustee is the voter. So again, the trust is the single shareholder and 100% ESOP. I should mention here that an ESOP can own any percentage of a company. An ESOP can own 1%, an ESOP can own 100%. The rules are agnostic about the percentage of ownership. The significant tax advantages come at 100% ownership, but we see plenty of companies that put an ESOP in place, and the ESOP owns a smaller percentage of the company, and that value and those benefits that we're talking about would apply to that minority percentage. In most cases, the ESOP is voting the shares the trustee is voting the shares owned by the trust. In some limited special circumstances, the trustee will go to the participants and ask for their input on the vote of those shares, but overall, the trustee has the fiduciary responsibility for deciding how those shares are going to get voted. The individual participants in the ESOP are not entitled to see company financial statements. They are not entitled to see the valuation. They are not entitled to make important strategic decisions for the company. Those decisions, as we're going to talk about, still lie in the hands of the management team and the board of directors, even once the ESOP trust becomes a shareholder. So this is the governance structure in every corporation in the world. There is, all right, maybe I should say the United States, not sure about some other countries, but the shareholder is the top of the chain of command. The shareholder elects the board of directors. The board manages the president and the CEO. The president and the CEO manages the management team, and the management team manages the employees. The day after the deal, that this chain of command does not change. The only thing that changes is that you add to the top of the mix that the ESOP trust is either A or the only owner, and then it, along with whoever the current individual owners are, become responsible for electing the board, which in turn is dealing with the president and the CEO. President and CEO in turn is managing the management team, and the employees are responding to the management team. The strategic and operational structure of a company does not change as a result of an ESOP. It runs exactly the same, or should, after the deal as before the deal, again, with the value of the business being driven into the accounts of employees who are part of the ESOP trust, as opposed to those decisions and that profitability being driven into the individual owners. And I think there's a question about whether the president and CEO is a participant in the trust, and the answer is yes, unless they've taken advantage, unless they were the owner and they've taken advantage of a tax deferral. The governance of who's on the board is determined by the trust. It's very common for the owners to stay on the board either indefinitely or for a period of time after the deal. As we're going to talk about, these are leveraged buyouts. Paying off the debt is critically important. So making sure that the company is stable and is generating cash flow after the transaction that's going to pay off the debt, very important. And so often continuity in the management team and the board is critical to those advantages of being the company's operating stably after the deal is over. That's a huge consideration in the planning of the transaction.
All right, Beth, just one comment, if I may. It's important to understand that the trustee is not a board member. The board member is selected by the shareholders, but the ESOP trustee has no responsibilities for establishing strategy, compensation, and other direction of the company. Thanks, Mary Beth.
Thank you. And that's a perfect segue, because now we're going to talk a bit about the steps of the transaction. So Bob's going to take over now and talk about how you actually make all of this a reality.
Okay, we're going to talk about the most typical transaction, which is where the ESOP is funded with either outside financing or seller financing or a combination of both. And the key is really to keep the different parties straight as you're thinking through this transaction. So in this diagram, we've got our contractor, we've got our source of financing, the bank and the seller. We've got our new buyer, which is the ESOP, and we've got our selling shareholders. So in the first step, what's going to happen is the corporation is going to borrow money from the bank. And the purpose of that loan is to finance part of the transactions. So in the second step, and this loan between the bank and the company is a typical bank loan. The company is going to debit cash and credit long-term debt. It's probably going to be a 5-year term loan. It may be a 7-year term loan with a 5-year balloon, but it's typically a commercial loan with typical commercial terms. So the corporation now has the capital, and it's going to go ahead and make that loan to the ESOP. And now the ESOP has the capital to finance this transaction. The terms of that loan between the company and the ESOP will be different than the loan term between the bank and the company. And the reason for that is because the term of the ESOP loan, whether it's 5 years, 10 years, 20 years, or 30 years, will determine how quickly the shares that the trust bought get put into the employees' accounts. If it's a 10-year loan, then 10% of the shares that the trust bought will be allocated to the employees each year. If it's a 30-year loan, it'll be just over 3% per year, et cetera, et cetera. So we're almost through this transaction. The trust now has the capital, having signed a loan between the company and itself, and now it's going to trade that cash for shares. And at this point in time now, the ESOP has shares. Its balance sheet looks like this. It's got $10 million of company stock, and it's got $10 million of debt. So essentially it purchased this stock with no money down. And we'll see in a moment where the trust ultimately repays this debt. So this is the common transaction. Let me just go to the repayment. So now imagine we're going through the year, and the first thing that's going to happen is the company is going to be repaying the bank probably on a monthly basis, potentially on a quarterly basis. But this is going to be a loan like any other loan. It's just going to go. And so when we're evaluating the company's ability to finance bank debt and other debt, we're making sure that there's cash flow capacity and surety capacity to make that happen. So the company is going to go ahead and make these monthly payments to the bank. The loan repayment between the company and the ESOP just happens once a year, and typically at year end. So what happens is the corporation will go ahead and make a contribution to the ESOP out of pre-tax capital, right? This is a retirement expense from the company's perspective. And the dollar amount of that contribution is going to be exactly equal to the obligation that the ESOP has back to the company. So the corporation makes this contribution to the ESOP in an amount sufficient for the ESOP to repay its debt. And so this transaction, the contribution to the trust and the ESOP loan repayment to the company, is a non-cash transaction. This is very important to understand because, number one, this loan isn't using up any cash from the company. And number two, this contribution is establishing the tax deduction for the company's purposes. And again, if the company is making these contributions over a 5-year period, then the entire value of that transaction will be deductible over 5 years. If the company is making those contributions over a 30-year period, then the total value of that transaction will benefit or will be deducted by the corporation over 30 years. The other
Hey, Bob, we're getting some questions about the trustee. If we can maybe just address what makes a good trustee, what do lenders look for, that sort of thing. Just a 30-second side note would be great.
Yeah, that's a great question. Well, first of all, the board of directors is responsible for interviewing trustee candidates. And what they're looking for really is a person with financial acumen, with ESOP transaction experience, and decent insurance policies, right? Because ultimately, they want to make certain that if something goes wrong, that there's protection by the trustee. These trustees tend to be oftentimes attorneys or trust officers in their former lives. But I think the critical factor is ESOP transaction experience. The lenders typically do not have an opinion about whether it's a good trustee or a bad trustee. I think Pilot Hill Advisors and Kleinbard in advising their clients will make introductions to people that have the experience that is fitting the transaction that the client is undertaking. And so I think those are really the primary parameters. And ultimately, the introductions that we'll be making to the board will all have the capability and the talent and the experience to do the work. And I think as often as not, and Mary Beth, I'm interested in your opinion, it's really more of a cultural fit with the trustee, assuming that the candidates that we're presenting are capable and qualified, which they would be. But oftentimes it's very much a culture fit with the company. Mary Beth, do you have an opinion?
Yeah, the only thing I would say is absolutely, I agree 100% with what Bob said. To start off at the top, you have some choices. There are a couple of very large ESOP trustees in the country who are companies, trust companies, and they have officers who are the individual people who would be your point of contact when the trust company is making the decision about the deal. Then there, as Bob mentioned, there are some individuals who on their own and with their own, fiduciary protection are making the decisions. The cultural fit, I think, is critical because not only is this person going to be making the purchase decision, but this person is going to be, you hope, a partner to the company in the future because, as I said, they're the people who are making the decision about the stock value going forward. And obviously, if you're looking at transaction experience, you get the benefit of all the deals they've done. So you want to be able to call them and say, how many construction company deals have you done? How many have you done in this region? How many have you done with this many sellers? How many have you, how many have you done with, in this particular, area of expertise? And what was your experience in those deals? The president and the CEO I would say, really should not be the trustee. I mean, what you need for the trustee is somebody who can independently review the company's financial performance. You want them to be looking at historical performance. They're going to look at projections the way any buyer would. They're going to be looking at the strategic plan. They're going to be looking at succession planning overall. And I think you want both the optics and the reality of that objectivity and that kind of dispassion about the way the company has been operating. So I think Bob and I would always recommend that you get an external trustee, and you want to get a person that you think is a good cultural fit for what you're trying to do.
Mary Beth, excellent points. Regarding the velocity of the ESOP contributions and the loan repayments, there's no difference if ABC Contractors is an S Corp or a C corporation. Those benefits accrue the same. There are some different deduction limits, but they're a subtlety that we could get into later. They're essentially the same. The last point I want to make on this slide is
somebody asked the question about whether the numbers here for 1, 2, and 3 are the same. And the answer is in many deals, they are not, because number 2 and 3 will be the same. 1 is just the bank loan, but there could also be seller debt. So it is possible that the ESOP's total purchase price is higher than the amount of the term loan that's going to the bank.
Yeah. We also got a question about surety and how the ESOP may affect the surety relationship between the contractor and the surety company. Do you have a slide on that, Bob, or is that something that we should just try to address in a question?
No, we've got that in the other consideration section down the road. So if we can punt that till a few slides down, we'll cover that for sure.
Okay, good.
So the last point I want to make on this slide is that when you look at number 3, the larger that the payment that the ESOP makes to the company, the more shares that the ESOP is going to put in employees' accounts in a given year. So the shorter the ESOP loan and therefore the larger the repayment, the more shares are allocated to the employees' accounts and vice versa. So when we're analyzing what is ultimately the estimated value of the ESOP benefit that's put in employees' accounts every year, this is really what we're thinking about. And because the company is the one that decides how long this loan will be, we're trying to determine to our best ability how much the target ESOP benefit should be in a given year. And depending on the stock price growth rate, the number of employees, and so on and so forth, we try and we try and triangulate what the best loan term is between the company and the ESOP. So at the end of the day, in our transaction, the owners are going to realize proceeds from the transaction. They're going to convert what is equity in a single stock portfolio, that is their company, to liquidity that can be invested in a broad range of securities, and therefore diversify their returns. If they structure the transaction properly, they won't have to pay their capital gain taxes for an indefinite period of time. The control of the shares acquired by the ESOP, that is the vote, is exercised by the ESOP trustee, but also understand that number one, the trustee is appointed by the board, and number two, the board is running the company and directing the CEO, not the ESOP trustee. The employees are receiving a new retirement benefit that's tied to the success of the company. This is what is the motivational part of the business. Each year, as more shares are put into their accounts, their value is going to grow, hopefully. And if they can, one, accumulate shares year to year, and also help enhance the value of the business by productivity and whatnot, then not only are they getting more shares, but the value of those shares go up. And ultimately, they will accrue that benefit over time. And when they leave the business, the corporation is obligated to pay them out. And we're going to talk about what those terms are in a moment. And then lastly, the corporation is funding this shareholder transaction on a pre-tax basis, whereas if it were straight redemption, this is going to be an after-tax transaction. So there can be some considerable benefits for everybody if this is structured properly. In terms of the annual ESOP activity, really there are a few things that happen. So what we've talked about is we've talked about the transaction. We did illustrate what the repayment activity is, but from an annual perspective, a few things happen. Number one, the trustee is responsible for updating the stock price every year. So every year, the trustee's valuation advisor will update the stock price. The trustee will also vote the shares for the board of directors. The board of directors will authorize the annual ESOP contribution, and that authorization is going to range between what that loan agreement says and what the government regulations say is the maximum contribution that the ESOP at the company could fund. And the board will consider the benefits and limitations of that range. The ESOP is going to make a loan payment back to the company, and then a third-party administrator will take care of all the accounting and bookkeeping and compliance testing for those number of shares that had been put in the employees' accounts. So that the trustee or the trustee will allocate those shares that have been paid for based on the rules of the plan. It'll complete the compliance testing, because every retirement plan, as you all know, have a number of different discrimination tests and whatnot that will be run. The third-party plan administrator will also prepare the tax return, which is the IRS Form 5500. And of course, the trustee will pay out the benefits at the direction of the company when those come due. So that is the annual activity. Mary Beth, I'm going to turn it over to you.
Okay, I'm gonna, if it's okay with everybody, I'm gonna backtrack a tiny bit, just because this thing that we keep talking about is this series of slides that we talked about is the reason that private equity and strategic buyers sometimes look more attractive, because this is complicated. I want to go back and just emphasize something that Bob talked about, because this affects, when we get into the the surety issues and the bank debt and all those cash flow issues, this concept, understanding kind of where the company's cash flows end up after you've done the deal, are kind of critical to the whole ball of wax here. So the company is going to be using ongoing cash flows, which, as we've talked about, are enhanced potentially by the fact that the company is no longer paying corporate taxes. And also, maybe if the deal is somewhat seller financed, enhanced by the fact that the seller maybe is a more forgiving buyer, a more long-term lender, than the bank would be. So cash Company cash flows are going to pay back bank debt. They're going to pay for operations the way they always do, compensation, bonuses, equipment, surety, all the ongoing insurance requirements, everything else the company needs to do. And then in addition to that, the company is deciding this additional employee benefit. So there've been a lot of questions about, how does this fit in with compensation? How does it fit in with a 401k plan? I would say 99% of my clients who have ESOPs continue to make a contribution to the 401k plan, and many times up to the same magnitude they were making it before the transaction. And the reason for that is that the 401k plan in a lot of companies kind of serves a different purpose. It's letting people defer, which is a big benefit that you can't do with the ESOP. Plus the company might have a match in the form of profit sharing or in the form of just a safe harbor cash contribution. What many companies do, because you're adding on this ESOP benefit, which is a significant additional benefit for people that they're not paying for, is reduce the 401k contribution to kind of hit an employee benefit number that makes sense for the company as a whole. So this internal ESOP loan that we keep talking about, although it's called a loan, is really the rate of employee benefit. So it's important to think about it that way. So as Bob said, if it's 30 years, it means that the bucket of shares that the ESOP purchased from the seller in year one would finally be, out in the hands of all the people who work at the company only after 30 years. And so what the company is measuring is how much is 1/30th of the company's stock worth in any given year, because that's the amount that's going to people. And that number, as Bob said, is going to have to be repurchased by the company when it's all over. So this slide, when you get these slides after this is over, this slide and the following slides are kind of, the meat in some ways of what a company is deciding to do. It's taking on the burden of the purchase price, it's gaining the value of the tax benefit, and it's figuring out how to value a bucket of shares that are going into the hands of people who work at the company year after year. So I know everybody always has a ton of questions about that. We can, answer specific questions or general questions about that, as we go along. So, and again, the trustee is deciding how much is all of this worth, right? I mean, when at the start, when the trustee is deciding, I'm going to buy a bucket of shares from people, or from a person or from a group of people, how much are those shares really worth? Okay, so now we're going to talk about this thing that I know sounds really crazy, but is really true. So from a seller's point of view, the ESOP offers is the ability to buy the shares of company stock if this seems like the best transaction to do for the seller, and either other buyers are not offering what the seller wants, or they're going to destroy the culture of the company, or they're going to move the company, or they're not going to care for employees in the same way. This is what the seller can get out of an ESOP. The seller can put the ESOP up across the table, and the seller can negotiate with the buyer to purchase all or a portion of the stock from the seller. These deals get done as stock deals, not as asset deals, which means that the seller gets the advantage of long-term capital gain on the sale of the stock. And the seller typically would pay taxes on those proceeds, on the gain resulting from those proceeds at the time the deal is closed. If the seller is taking a note and the seller elects installment treatment on the note, then the seller might have the ability to defer that gain over time. But in most cases, the seller might expect that if I'm going to sell my stock and I'm going to receive proceeds for that stock, I'm going to have a capital gain transaction, and I'm going to pay capital gain on that, on the basis of that rate. And for a lot of our deals, we're talking about a founder or a shareholder who was there right from the start. Their basis is very, very low. And so that gain has the potential to be very, very high. So what an ESOP offers that other buyers may not offer is the ability for the seller to roll over the proceeds into like-kind property and thereby defer the capital gain, sometimes indefinitely. So the way this works, it works very similar to the structure of a 1031 property exchange. If you've seen situations where a seller owns real estate, the seller sells the real estate, reinvests the proceeds in another kind of real estate, the seller can defer the capital gain on that real estate sale under Section 1031 of the code. There is an analogous code section called 1042, not called 1042, numbered 1042, in the code, and it does the exact same thing. The seller owns stock of a privately held company, and the seller sells that stock, invests it in another operating company, or bonds of another operating company in the United States. The seller has the ability to defer the capital gain until that replacement property is sold. This is all true. It has a little bit more complexity to a deal that's always, already a little bit complex. So you need a particular kind of patient seller, but it really works. And for sellers in particular who are older, over 90, and they invest their property and they invest in this qualified replacement property, and that property is in their estate when they die, their beneficiaries get the step up in that basis and nobody ever pays taxes on it. But there are investment strategies that people have worked out for this qualified replacement property, and they work beautifully. The only two requirements, there's a third one that's smaller, but the two main ones that you have to worry about is that it has to happen in a C corporation. So when we talked about a company operating without paying taxes, that is permitted only in an S corporation. To do the 1042 deferral, the company has to be a C corporation at the time of the deal. It can become an S corporation later, and the ESOP has to own at least 30% of the company's stock. But if those two things are true and the seller is selling into the ESOP, this 1042 deferral is a possibility. So we have a lot still to cover. So I'm gonna just go through this quickly. The choice of the qualified replacement property is an important decision. You probably want to work with an advisor who is knowledgeable in what constitutes QRP. You don't want to make a mistake on that, because if it really isn't qualified replacement property, then the deferral doesn't work. So there's a range of investments. Some of them are long-term investments. Some of them look more like managed portfolios. But if you hold on to that portfolio and the qualified replacement property is not sold, then you have satisfactorily maintained the deferral of the capital gain. As long as you have purchased the QRP within 12 months after the ESOP sale takes place, that QRP counts for purposes of deferring the capital gain. So there are a range of investment strategies. One is, again, to manage the portfolio, and you buy and sell things within that portfolio, often using a margin strategy, so the seller isn't coming up with cash to do it. And then there's also what people call a more long-term active deferral, which is you buy a single thing, that thing lasts for 50 years or 100 years, and you can pledge that as a collateral for a loan that you can spend more actively. So for sellers who are looking for true liquidity, they want to buy a boat, or they want to buy an island, or they want to buy a bigger house, and they can't have this QRP locked up for a period of time, there are ways to do both, where you can successfully defer the capital gain, but also borrow against that QRP so that you have some liquidity to spend on more fun things than QRP. So it's an important part of the strategy. It is a distinguishing characteristic for sure of an ESOP, and something that, sellers should look into, I think, to take, advantage of the full ESOP benefits. This is, the tax deferral should be part of any transaction analysis. There are a lot of sellers who hear about these rules and they say, it sounds too complicated. I don't think I really can do that right now. I want to spend my money. I can't figure it out. It is easy to figure it out at the front end. You get a single time to do it. And again, because you have to do it within 12 months after the deal, it's important before the deal to make sure that either you're comfortable paying the capital gain and you're happy to do the deal without the deferral as part of the structure, but it's easy enough to do it on the front end. And again, because it is such in states where the state capital gain deferral, the state capital gain tax is 10%, you're talking about a 30% after tax difference to the seller if you can successfully do a 1042 deferral, and it should not be ignored as a factor. And just the last point I want to mention on this is it's not all or nothing. You can get a $50 million purchase price for the deal and defer the capital gain on 20 million of that purchase. You do not have to defer the capital gain on the entire purchase. Okay, Bob, back to you.
Thank you, Mary Beth. So let's talk a little bit about the corporate benefits, and this is a pretty straightforward mathematics. And I think simply in your own mind's eye, what you do is you say, if we're going to do a $10 million transaction, the value of those deductions are the value of the transaction times your tax rate. So if it's a $10 million stock transaction and there's a 32% combined tax rate, then the government's picking up $3.2 million of this transaction. And that's the same whether it's an S corp or a C corp. And I've just sort of created a short table here. We're taking the tax rate times the total deductions. So we have a $10 million transaction, which is $10 million loan amount. And we multiply that by the 32%, we've got a $3.2 million deduction. So the cash cost of the principal is 6.8. The interest expense is the same, and so we're saving basically $3.2 million. Now that's a S corp or C corp. Now, if it is a 100% S corp ESOP, of course, there is no taxation anyway, and we'll illustrate that here in a little bit. But the point is that the value of the ESOP transaction times the tax rate is the deduction cost to the corporation. So the S corporation story, just to put a little bit more around it, understand that S corp shareholders are responsible for paying taxes rather than the entity itself, right? If the ESOP is a 100% shareholder of an S corporation, because it's a non-taxpayer, then all of the taxable income is attributable to the ESOP that doesn't own taxes. And therefore, the ESOP will get a K-1 for all of the taxable income. But as a tax-exempt entity, it just rips that up, doesn't pay the taxes, and that cash stays in the company to do whatever it needs to do, repay the debt, grow the business, buy equipment, pay bonuses, whatever. And there's been a dramatic shift in the number of 100% ESOPs since this legislation was first put in place, which is now, 14 or more years ago. The Small Business Job Protection Act, I don't recall exactly the year, but it's been a long time. And there's clearly a motivation to eliminate taxation to get to that 100%. So historically, whereas company owners would typically start out with a 30 or 40% transaction and then ultimately go to 100 later on, they're now going and doing that 100% transaction up front. And that's knocking off about 2 or 3 years of debt service by virtue of that cash flow savings. You're on mute, Mary Beth.
Sorry about that. This goes back to the employee benefit rate that we talked about, which is an important consideration. One thing, just to keep in mind, back to the governance point about who makes these decisions about how employees benefit from an ESOP. These are all board and management team decisions. The trustee does not weigh in on who gets to keep the shares, at what rate they accumulate their shares, the period of time over which those shares are put into people's accounts. Those are all decisions made by the board and typically by the management team and less by the board. And these are all critical parts of the transaction planning, because to go back to the example that we used before, if we take a transaction where the ESOP purchases 100% of the stock in a single transaction, where all the seller or the sellers sell everything they have all at once, the ESOP trust is buying those shares all at once on a single day. But if you looked at the people who work at the company on that day, they have nothing in their accounts at that moment. So those shares, when they're purchased, sit in what's called a suspense account. And then if the company has determined, going back to the example Bob gave before, that those shares are going to be allocated out to people over 30 years, somebody's going to have to stick around for a while before those shares are fully in their account. On the other hand, the good news is, first of all, the company doesn't buy back those shares, until people leave, and they're buying them back at a slower rate. And secondly, when you hire somebody 10 years from now, you want to be able to say to that new person, we are an ESOP company, and you will get shares in the ESOP by virtue of the fact that you have come here and you are going to be working, and you don't face a problem where you give out all the shares on the first day and you hire somebody 10 years later and the only way they can get shares is when people leave the company. You don't want that. So there's a lot of planning that goes into this. The company is going to look at sort of models of how many employees there are, how long it could take to put the shares into people's accounts. And then based on the company's turnover, how quickly those shares might come out of one person's account and be reallocated back into another person's account. That's all part of the employee benefit analysis, with the big question underlying all of this: what do we think the stock is going to be worth? Because over time, as people get shares into their accounts, and as those shares vest, and as the stock value goes up, which it will do because the company is paying off debt and because most companies you hope are growing, the company is trying to keep track of what are we really talking about in terms of cash flow, because we are going to have to buy back those shares from people eventually. The employees do not pay taxes on either the allocation of shares into their account or on the growth in the shares in those accounts over time. They pay taxes only when the shares come out of their account, and at that time they pay ordinary income tax. The timing of when people get their benefits and the vesting and those questions are somewhat boxed in by IRS and DOL rules, but generally the company has some flexibility. On the payout timing, if somebody leaves the company because of death, disability, or retirement, you have to start paying them out the year following, and then you have 5 years to pay them out. If they leave for a reason other than death, disability, or retirement, you can wait up to 5 years before you begin paying them, and then you can pay them over 5 years. So the company has time. All of these rules are designed to give the company time to come up with the cash to pay people out, because you're taking an investment in stock, you're converting it into an investment in cash, and you want the company to have some time to plan for that cash flow. So the rules, again, are designed at the beginning by the company. In a lot of companies, the goal is to kind of mirror those rules to the degree possible with the 401k plan, so that you don't have a situation where somebody is retired under the 401k plan, but they've not yet met the rules of being retired under the ESOP. And at the same time, again, you want the company to be able to have time to really plan for this and to pay people out. The ESOPs that have been around for 50 years, and there are some ESOPs that have been around for more than 50 years, as you can imagine, those shares have changed hands over and over and over and over again. It's almost like a public company in the sense that that market for stock is perpetual, and it has nothing to do with the employees who are at the company at the day the ESOP is put into place. But as the employee base changes over time, those shares are coming into and out of their accounts many, many times. And then eventually the goal, you hope, is that the company is going to be able to buy back those shares, which in well-run companies, they always do. And then the employee sees the retirement benefit when they get their payout. And yes, once you get the benefit, just like with other retirement distribution payouts, you can roll those balances or distributions into IRAs and other qualified plans and defer the taxes until you get up to age 72 or 73 or 75. Now those ages are going up and up, and then at some point you are required to pay the required minimum distributions.
Okay, I'm going to take a few minutes to talk about some other considerations, things to be thinking about. Obviously, the seller is the starting point, or the shareholders are the starting point for this whole equation. And really, we're talking to folks that are looking to create some liquidity for their shares. You know, when we're evaluating the capacity of the company, we're really looking at its ability to finance a transaction. This is capital that's not going to grow the business or expand the business or do other things. It's capital that's leaving the business. So we need to make certain that the company has the ability to take a portion of its cash flow and divert it to a transaction that's not creating ultimate value for the business. It's leaving the business. We have to look at the impact on key employees, typically our management team. And oftentimes, as part of these transactions, we're creating benefits outside of the ESOP tied to company growth for key employees to create an extra incentive for them to continue to perform. We have to look at the impact on the company's borrowing capacity, but also their bonding capacity, and the accounting is a little quirky for ESOP accounting, which throws a lot of sureties into a bit of confusion. We'll talk about that in a moment. And then obviously we have to look at the employee demographics to make certain that we don't have too many employees that are retiring at the very same time, which creates a larger repurchase obligation. This typically is not an issue, but it's something that's critical to look at in the planning process to make certain that the company is aware of when these obligations may come due. Important to understand that if the ESOP owes money to the company, people that are not at retirement age may have to wait until that loan is repaid. Let's talk about some of the appraisal requirements. As I mentioned earlier, privately held companies have to have their stock valued by an independent third-party appraiser who is hired by the trustee. This is not a company advisor. Pilot Hill advisors will do evaluation for the company's benefit and for the purpose of making an offer that is at least reasonable and thought through. The appraisal for a stock transaction has to be as of that date, but thereafter at least annually. There are a number of different valuation methodologies that are used. Typically, there are earnings valuation methods, discounted cash flow, earnings capitalization, and others. These are the primary indicators of value, but the appraisers also look at market methods, which include comparing them to publicly traded businesses, as well as recent M&A deals for industries and businesses that are similar to the company that we're valuing. Also important is normalizing historical earnings. If owners are taking out a lot of compensation or excess compensation that they're calling wages, but really they're a return on capital, if they're willing to adjust their comp to market levels, then we can add that capital back and capitalize that in the valuation process. And then finally, if there have been any prior transactions or offers that have been made for the business, under certain circumstances, they can be used as an indicator of value as well.
Hey, Bob, I've got a great question here. What happens if a company fails? What happens to the retirement benefits in the ESOP? And are the employees somehow made whole?
Well, the value of the company stock, if the value of the company stock becomes zero, then the shares in people's accounts or in that employee stock owners or trust is worth zero. Now, it's pretty common that the trust will also have some cash invested in other investments other than company stock. And to the extent that there is cash in the plan as well, of course, that's still there to split up. But if the company's stock becomes worthless, then the value of that ESOP trust becomes worthless like everybody else.
Got it. Well, Mark, that was an easier question than I had feared, but anyway, good question. Thank you.
So some other things to think about as we're evaluating and thinking through these ESOP transactions. Number one, a number of different entities, LLCs, S corps, partnerships can have ESOPs so long as they're structured properly. We're not going to get into that in this program, but we can certainly take that offline. Oftentimes, owners own the company or own the real estate that the company is using. And so this closely held real estate, really what we're looking at is making certain that the loan terms are at arm's length and that they're at fair market value. If there are subsidies or surpluses, that could affect the valuation. The trustee is going to be very keen on making certain that there's a good management bench, that it's not just run by one person and one person is making all the decisions. This is probably one of the things that we see most often as a disqualifier for companies doing ESOPs, and that is there's a great owner who's grown the business and developed a great business, but there's really nobody behind them to take the lead. That's probably not a great circumstance or set of facts for an ESOP transaction. The company's financial statement scope, we've seen everything from audits, reviews, compilations, even tax returns. We like to see audits, but reviews are probably most common. There's no requirement for one or the other. So if a company has a compilation, that's acceptable. It's not optimal for a number of reasons, but it's acceptable. There isn't a requirement that a company sponsoring ESOP have an audit. ESOP accounting is a longer discussion, but I'll summarize it this way. And it relates to the bonding capacity, because sureties are going to be looking at working capital and net worth. And the way the accounting works in ESOP transactions is that if a corporation borrows $5 million to finance an ESOP transaction and it's making a loan to the ESOP, the corporation isn't booking an asset, which is what this loan sounds like, but it's booking a contra equity account. So if the book value of that company is $10 million before the transaction, and they book a $5 million ESOP transaction, that book value becomes $5 million. And as the ESOP pays off its loan, that $5 million decreases to where after the ESOP loan has been repaid, it's zero. And so that post-transaction accounting requires some explanation to a lot of sureties. But I will tell you, the irony of that accounting is that when the ESOP repurchase obligation is the least, and when that contra equity count is the most, is when there is no repurchase obligation. As Mary Beth said, on day one, in a $5 million transaction, our balance sheet book value is going to look the worst, but there is no repurchase obligation attached to it. When that contra equity account goes away and the sureties don't see that number is when that obligation is the largest. So we've had many discussions with the sureties and the underwriters to talk about that. The other thing, of course, we look at carefully is the debt capacity, and we can't use every dime the company generates to pay for the stock. We got to leave room for the company to grow. There are lots of things that we've covered here, and both Mary Beth and I are available to take calls, emails, what have you, for those folks that have joined us today. We can also do an ESOP 202 seminar if you like, but we both want to thank you very much for joining us today. Wayne, you can close it up if you like. The remaining slides are just brag sheets for, well, I guess they're steps. So let's talk about the steps. I jumped ahead here. Really, it's about transaction planning, which is what we're doing to help owners figure out if and how this might work, proposing different structures to accomplish their goals, and then the execution. So the planning work really is a 1 to 2 month process, and the transaction work typically takes in and around 3 or 4 months once owners are all on board with how to do it. Now I'll turn it over to you, Wayne.
All right, Bob,
Wayne, do you mind if let me just make one more comment, if I might, about the planning. I would say 2 things about the planning. First of all, somebody in the comments, I think, wisely made the choice, bring people in early, bring the surety in early. As soon as you're ready to start having a specific conversation. I realize confidentiality is an issue. So you have to be sensitive about that, but the earlier the better. Nobody wants to do a deal that's rushed. The other comment I would make is, people ask us frequently, should we do an ESOP transaction? Does it make sense? To which my answer always is, compared to what? Sellers are thinking about a number of different possibilities, selling to the people who work at the company in a management buyout, selling to their kids, selling to a strategic, selling to PE, selling to an ESOP. All of those things are possible. All of them provide benefits. Whether one checks off more boxes than another takes some consideration. It takes some real soul searching for sellers to figure out what they're trying to get out of the deal and whether one deal is going to satisfy those needs over another deal. So planning is critical, but I think what Bob and I can both do, and Wayne can do, is help you figure out what are the real exits for this business, which ones make the most sense, and does an ESOP fit into that array of things that could end up being a good idea. Thank you, Wayne. Sorry.
All right. Well, Mary Beth and Bob, this has been awesome. We've never gotten so many questions during a webinar before, I can tell you that. Jim, Charles, Chris, Brian, and Nate, I'll have Bob follow up with you directly. I'll pass along your contact info there. We're already getting calls for an ESOP 201 presentation. So roll up your sleeves, Bob and Mary Beth. Maybe there's some more work to do here. All right. We'll email the slides and the recording to everyone, a link anyway. And then on our website, we'll have them posted within about 24 hours. So be on the lookout. And if you have any more questions, get in touch with either Bob, Mary Beth, or me, and we'll try to point you in the right direction. Remember, ESOPs aren't for everybody. They may not be right for your construction company, but it's just another tool you have to evaluate as you think about ownership succession. This is Wayne Rivers at Performance Construction Advisors, where we build better contractors. Thank you.